Good evening, everyone. Welcome to Markets with India's weekly market wrap. This is Rajshekar Kongari, Equity Research Analyst at William O'Neill, India. In this podcast, I'll be discussing about the current market status. Major events happened during the week, domestic and globally. We'll close the session by giving an outlook for the coming week. Let's start by analyzing Nifty's daily chart. Last month, we had an occurrence of a follow-through day. Hence, we changed the market status to confirmed uptrend. Since then, market moved sideways. After reclaiming its 100 EMA, there was a good uptrend. In this particular region, we started to accumulate stocks which are given very good buy points. Talking about this week's Nifty performance, on Monday, Nifty gapped up because of merger news between HDFC and HDFC Bank. Given their high weightage in the index, Nifty had to gap up as the stocks closed more than 10% higher on that particular day. However, as the week progressed, these stocks have given up their gains and they are back to their pre-merger news levels. Nifty also followed the suit, and for the next three sessions, it closed lower. We had an occurrence of distribution day as well during the week. This is the first occurrence of distribution day. Hence, the count is at 1. Distribution day is when Nifty closes 0.2% or more on volume higher than the previous session. However, today's session is a very healthy one for the Nifty, given the volatile moves during the day. For the week, Nifty closed 0.6% higher. Broader market indices clearly outperformed in Nifty as mid-cap closed more than 3.6% higher for the week. Coming to the sectoral performance, FMCG and metal stocks have done pretty good for the week. Talking about the major events globally, as we all know, Fed had increased interest rates by 0.25% last month for the first time. However, its minutes have unveiled that most of its participants wanted more rate hike, that is 0.5%. Hence, we might expect a 0.5% rate hike in its upcoming meetings. Its minutes have also pointed at a trimming of its balance sheet at a pace of $95 billion per month. Central bank had to take these steps because of higher inflation rates in the country. For the month of February, US inflation came in at more than 7%, which was a 40-year high. Reacting to this news, US 10-year Treasury bond yields have increased significantly to 2.7%, which is a 3-year high. There was also a brief moment of inversion between 2-year and 10-year bond yields. However, it came back to normal levels. Hence, we don't need to panic at this particular point. Coming to European nations, they have also been tackling the higher inflation rates because of supply chain constraints which are raised due to geopolitical tensions. Hence, European Central Bank has also, its meetings have also pointed at a more hawkish stance going forward. Hawkish stance means Central Bank is going to increase the interest rates. It is about to focus on curbing inflation rather than increasing the growth. Today, RBI's MPC outcome had come in during the market hours. Hence, today's action was highly volatile. We have sent out a detailed note on this particular event. However, to explain briefly, key policy rates like repo and reverse repo have kept unchanged. Repo at 4%, reverse repo at 3.35%. RBI has shifted its focus on withdrawal of accommodative stance, which means they might increase the interest rates going forward because of higher inflation rates in the country. GDP estimate for this year FY23 is revised down to 7.2% from the previously estimated 7.8%. The reasons are many. One of the major reasons is higher crude oil prices globally. RBI is estimating an average crude oil price of $100 per barrel going forward from a previously estimated $75 per month. Hence, it is weighing down on inflation as well. Thus, inflation for FY23 is revised higher to 5.7% from previously estimated 4.5%. To take out the excess cash in the economy, RBI has introduced a new policy called as a standing deposit facility. According to this facility, banks can park their unutilized funds with the RBI at an interest rate of 3.75%. Talking about the outlook for the next week, even though there have been many negative news floating around the globe, Indian markets have been doing pretty much well. In Nifty is trading above its all key moving averages like 50 200 DMS, which is a very good sign for the longs. We have added more than 12 stocks to the model portfolio, and we continue to remain bullish on these particular stocks. However, if there is any underperformance in these portfolio stocks, we might remove them. Please track our emails to check our additions and removals. Going forward, it is very crucial to track weakness in the markets. Distribution days are a very key trait which gives indication of weakness. Any accumulation of distribution days to around 3 to 5, we might change the market status to uptrend under pressure. In such a scenario, our approach towards the market will turn cautious. Thanks for joining our podcast. Have a happy weekend.